Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Hello, welcome to Private Banking Strategies with Vance, Lowe, and Seth Hicks. Vance, how are you?
I'm doing great today. I think we've got a good topic.
Yeah, this will definitely be a multi-part series for folks. One of the questions we often get from our clients and folks that are interested in private banking strategies is, how do policy loans work? That's how you access your cash value in your life insurance contracts. That is one of the fundamental principles for being able to be your own bank and to access your own cash that you're building and engage in the banking equation, which Nelson always said, you need to take the banking equation back in your life. So it's a deep dive today, folks, on how policy loans work. And it's going to be a multi-part series, and just looking forward to it. I often compare this principle, this cornerstone of being able to access your cash value, as like the eighth wonder of the world, like compounding interest. And we hear that is one of the great benefits and values that people utilize this strategy for. Wouldn't you say, Vance?
I would. Back in the day when we didn't have banks on every corner, we'd be lucky to have a bank in a territory. Life insurance served that purpose. It would allow us to store money and get access to it on a regular basis. And throughout the ages, we've been able to use that cash value to plan ahead. It gives us a very stable platform to know what the end results are going to be because of the guarantees and everything else. And we'll get into everything, but as an overall view, people, families would put their money in these life insurance contracts because they could access the money whenever they needed without any problem. But it would also grow at a very competitive rate. I don't know if people know, Seth, but the contracts, these whole life, these participating mutuals, between the profit part because of ownership and the guarantees, it's always stayed pace or beat the stock market, the net returns. Even today, it's that case. Long term, it always has, because life insurance deals with the word yield versus average rate of return. And it yielded people, which means money put in your account that cannot be reversed. The profits with a life insurance company, of course, are not guaranteed, but in a yield atmosphere, once money's put into your account, if the life insurance had a bad year or the economy had a bad year, they can't subtract anything. It's your money.
Right. And that's one of the beautiful parts about it, is that this capital that you're building in your life insurance, it continues to grow and compound year after year, whether you pull it out in policy loans or whether you don't. And that's through the non-direct recognition policies. And it's a tool that you can actually have your money in two places, earning income, earning interest, bringing a return on the same dollar in more than one place. And let me just give a quick illustration of that. We've talked about this many times, especially with our real estate investors. If you've capitalized your bank, your life insurance contract, with cash value, and let's say that you have $100,000 in cash value that you want to pull out and you want to purchase a investment real estate property like a duplex. And so you pay outright, don't have any other loan than the one that you created for your own banking system, and you pull out that $100,000 from your bank and you purchase that real estate and you get it rented up and you start getting $1,000 a door. You get $2,000 on that duplex a month after PI, everything is paid. So you've got your money in your policy and it's growing at between average rate of 4 to 7% compounding as if you didn't take it out. And you've got the $2,000 a month in rental cash flow coming back into your possession, which you then cycle back into your bank. That's called the velocity of money. And that's a really simple example, but it's a very strong one that illustrates the concept of being able to have your money in two places that's earning for you at the same time.
You see, Seth, I don't think people understand in general what money is, how it works, or how you use it. Because society before the early 1900s, people didn't spend money. They used money, just like the banks use money today. When the banks took over, they switched us, and out of ignorance actually, to spending our money, our capital, our principal. When we go to work and we go through that whole process, the money we bring home is principal. We're not supposed to spend any of it, but we
Right,
can use it.
right.
How do you use it and live and not spend it? You get it back. You put it to work, you use it, you get it back. It's called multiple touches on the dollar, which we want to go into. So, Seth, you said another thing in your example, and I just want to throw a question out because some people might ask, when they have $100,000 in cash value in their policy and they decide they're going to go self-finance or self-purchase something, how many copies of tax returns do they need to give to the life insurance company?
Zero.
Why?
No, because there's no nosy inquiry as to what you want to use the funds for or why or check your credit or any type of due diligence. It's effectively how much do you want and where do you want it sent?
Just those two questions. I've always found that amazing in today's society and in today's world. Folks, this is the most fun, refreshing way to live life and self-finance if you can get it going. But we all have to start. Another thing, Seth, that when we get into business and things like that, everybody thinks that banks are responsible for the statistics of business. How long it takes to make a profit, this, that, or the other. That's not so. It's all stems from life insurance and how long it takes for life insurance cash value to kick in. A new startup company averages 3 to 7 years. It's the same average for cash value to kick in, only we've figured out a way to start that immediately right up front. Let me give a good example. You and I go into business together. We've got the perfect idea. And we've just finished the budget, and we got to come out of pocket $25,000 a year to pay all the expenses for the business and keep the doors open. Under that scenario, people are expecting to do that for 3 to 7 years before any type of profit is seen out of that business. And it's so refreshing when I get to tell people or we talk to people how to, if you could pull back, you put $25,000 in, what if you could pull back 60% of that and be able to use that immediately in year one? Did we have a pretty good startup company? And then it just goes up from there. It doesn't reverse. It gets to over 100%. So I think that's phenomenal.
Yeah, it absolutely is. And that's why, some folks have called it the eighth wonder of the world. And ultimately we're talking about financial freedom. We're talking about financial security and flexibility. And that is a reason that people utilize private banking strategies. There's really no other financial vehicle that comes close to giving you these same advantages. And if there are, please tell me, folks, put them in the comments.
For my whole career, I've talked to people about what the perfect investment is. And everyone that hears this, we challenge you, write down all the things that you would think that a perfect investment would do for you. Realistically, okay? I mean, there's some weird things out there. But if you'll honestly do that, you'll find this contract will fulfill every one of them. It is the perfect investment. One more thing I'll lay on the table as we can discuss it further on is that our environment out there right now is not very friendly. Government's really trying to take control and turn our country, I know it's socialistic now, but they want to go further than that. What if we don't want to participate? What if we were to create our own environment, our own mini economy, which another word would be our own mini town, because that was the education that was lost. Independency, the family unit being able to survive on its own. Okay. That's also what we're talking about here.
Right. Financial freedom and security, that flexibility and the autonomy to be able to take the banking equation back in your own family system. What does that mean, take the banking equation back? Well, it's exactly like we just described. It's funding your own cash value, your own capital through your life insurance contracts, and then using that cash value for investment, for retirement, for the things that people generally just have one touch on that dollar for.
Let me do a little bit deeper dive in the bank, because sometimes Seth and I know what we're talking about, but sometimes people don't understand putting the banking equation in your life. Let's just do this. Let me share how simple this concept is. We know that the banks out there always get the money back. 100% of the time, they get the money back through collateral, whatever it is, even bad loans, they still get the money back. So they're always growing, they're never shrinking, and there's no free money Tuesday or Thursday. They don't give away free money. So what we mean when putting the banking equation back in your life is all new income coming in under your control literally gets put into your banking system first, and then it goes to work from that point so that it can return. That's what we mean. Without that bank, you cannot do that process. You're always going to be living the problem that we show people. We call it an open horseshoe economy, where we only get to use a dollar once and it can never come back.
Right.
Nelson Nash, we preach you've got to put the banking equation in your life. You've got to have that link to put the money in and then disperse it to work with
Right.
strings attached so that it always comes back.
Right. Yeah, that's right. Well, that's a great explanation, and I think drives home the point. I want to kind of shift into some, after that overview, a few drill down questions, because this is going to be kind of a drill down and an anatomy of policy loans. Let's just start on the top. What is a whole life insurance policy loan, and what are the benefits of that?
Okay, a lot of people are a little bit confused at this, and agents really perpetuate the confusion when we go to borrow money from our policies. And I understand that, because the person who wants money, it's easily explained, but it doesn't quite work the way they think. When you go to borrow from your cash value, you can only borrow a certain amount to up to 100%, depending on the company, but normally it's less than that. Seth, you can give the statistics in a minute here, but we do not borrow our actual cash. Just like Seth said earlier, our cash is always working for us. Even when we borrow money, we borrow the money against our cash value. It's called cash reserves. It's the cash reserves of the life insurance company. And what entitles us and puts us to the front of the line is that these contracts make us owners of the insurance company. And as such, we can, like I said, go to the head of the line. We get preferred loans, and we can't steal from our company. Okay. We're going to go to the cash reserves that they could easily take out and get interest on. So we're going to pay an interest on that money and collateralize the cash value we have working for us. Okay, the cash value is still there. It's still growing at the guaranteed rates. It's still going to get credited the profits, and we borrow the cash reserves of the life insurance. That's how we get double amounts, and insurance carriers are more than willing to do that because it's 100% cash reserved. They already have the money there to pay off the loan, and they will always have the money there to pay off the loan. But that allows us to take that money and put it to work.
There's no other more secure loan that could be made. I mean, you've got lenders making loans with 80% that they contribute to a purchaser's purchase of real property. And sometimes they still get upside down depending on which way the market moves. We'll compare that to the insurance company loans. They've got their cash value and the death benefit that they're going to pay out. So that is their collateral,
Hmm.
and that's why there's no questions asked. Let's drill down on this a little bit. So some folks call that living benefit. Like, it's really not about the death benefit in the policies where you're going to be paid the lump sum on the insured's life for the heirs, although that is a value and that is a part of the analysis, but it's not the main focus for banking. And so we're creating these systems and strategies for living benefits and building up the cash value for investment, for purposes that you need to live, and to fund retirement.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
What would be one of your main golden rules of why to take money out and for what purposes? Do you have any guidelines for folks on what the appropriate use of your cash value is?
I would believe the most preferred loan is one that we pull out from our policy that we have capitalized in advance, and to access that money through a loan. Only through a loan can we pay it back. There's other accesses to your cash value, and you can have the money, but you won't be able to put it back. And that's not for discussion today. So let's just say I need a car. I'm just starting out. I don't have a car to trade in. I need a car. I'm going to go set a budget. It's got to be within that budget, and I find a great deal. I can then go to the insurance carrier and immediately have money transferred into my account or wired to me very, very quickly within, let's call it 2 days or less, to have those funds needed for that account or for that project, for that car. Now, all I have to do is set myself up a system that I'm comfortable with, because now I'm in control of that loan, and the insurance company is not expecting that money back, by the way. That's why they don't ask any questions. It's your money. But the prudent rule, and what we need to understand, it gives the person a way to discover multiple uses on a dollar. If I pay it back, then as that money comes back in, it's reusable, and I still have the car. As it comes back, hopefully we can do one project, then another, and our volume of return in payments coming back is ever increasing. And we start to discover, this is what money's for. And then we can get into velocity a little bit, but it all stems from the use of money from a policy through a policy loan. So automobiles are great. Other things that people use are for education, for electronics, any number of things. Just be aware that you're borrowing the money, you want to pay it back. So Seth, let me ask you, I don't know if it's in our deep dive or not. What type of return do we want on our own loans? What do we want to make, and why do we want to make anything?
Right. Well, as a banker, you need to shift mindset, and to think like a banker, you're interested in cash flow. And sometimes we ask this question and analyze this issue with folks. Are you interested in just the interest rate, or is it the volume rate of return? And we compare those dynamics. And so as a banker, you want the highest interest rate that you formulate in the loan. And when you're paying yourself back, especially into a tax-free economy like the life insurance contracts are, you want to pay back as much interest as you can fit into your cash flow. And so, for example, we could use a high interest credit card balance. Let's say someone's holding $30,000 on a high interest credit card at 24%, but they've got $30,000 in their life insurance contract. What should they do, Vance? What would you counsel them to do?
Man, I'd buy that debt in a heartbeat. I would borrow the money. Going interest rate with the life insurance carriers is about 5%. Okay. But I'm making, on the average 7% on the same dollars. So I'm going to take that 30,000 and I'm going to buy that debt. My little lending company is going to buy the debt. So to the outside world, it's like paying it off. But no, I'm buying the debt because what I want is the volume of return, and I'm going to take that 35% or 24%, whatever it's going to be, because I can get it tax-free. Because I'm
Right.
using after-tax dollars, I'm putting it to work inside my economy, and I'm charging myself this amount of money. So how do you handle the question, Seth, when we borrow money from our life insurance, when they find out, what do you mean I have to pay interest? Why would I want to charge myself interest?
Because you're building your cash value. You're building the ability to finance future investment, future car purchase, or acquisition of high interest debt that you have, or even replacing real estate mortgages. So that interest that you're paying on top of principal into your banking system is money that can be used again immediately. And it's also compounding and growing year after year at a preferred rate.
So we're running an economy, folks. This is what Seth and I are talking about. Policy loans are one of the most essential thing to that operation. Money has to move in order to have any value. And so you've got money sitting. We also call the policy a money warehouse. We hold our money there until we can put it to work. And see, banks, they don't let money sit overnight in their account, in their banks. It's called overnight lending. It goes forward every 2 hours, all the way around the globe, back in their accounts in the morning. We have to do the same thing. Money has no value unless it's exchanged. And how many times can it exchange in a day is called velocity. So these loans allow us to purchase something, set up our own terms. What if I set up, Seth, on my car payment, I borrow $20,000 and I'm paying $500 a month, and all of a sudden I find it way too tight. Am I hosed? Am I stuck?
No,
Why?
because you've got access to cash value in your bank.
But also, I am the owner and the controller of that loan. Couldn't I reset and redo that loan down to a payment that I could afford?
You can modify loan transactions as you see fit because you're effectively the banker and the borrower.
And when people start the process, I take them through my experiences. I probably made every mistake in the book trying to set up my own self-banking. I had to refinance my own stuff 3 or 4 times just to get it right, just to get the balance right. But thank goodness for an opportunity to have loans. And guess what? These loans are private. Nobody knows what's going on here.
Right. So the question that I posed that we started to answer was, what are the best uses for your banking cash value, for the value that you've built up? What are the best uses? And we talked about things that you are going to have in life, like automobiles. We've talked about an investment, like a real estate investment, or it could be any type of investment that is creating a return on that investment and building cash flow that you can then service your own loan that you've created. Another big one is retirement.
Yes, yes. Be prepared though, folks. You're setting up a bank, a company. So you've got to have the capitalization in there, and it has to be what we call seasoned and producing at a more than 100% rate for money that's going in. But eventually that 7% or that amount of money coming out will be so significant that we could withdraw that or we could borrow that and do that for retirement, help replace income at retirement. We also don't like to say the word retirement very much. I know everyone's keyed into that because we're an entitlement society now, but there's no such thing as retirement. And I would pose the question out there to people, Seth, Does a town retire? Say, money still has to circulate. It's whether you want it to run out. And I've dealt my whole career with the fear that almost all people have because they switch out of production to what they consider as retirement and they start spending their nest egg. Well, I think that was created by government to get that nest egg. If they don't have it now, they want it. And the fear is, am I going to outlive it? Well, this philosophy we're talking about handing to people, let's say somebody retires, there's $1 million in the account. When they check out of life, it's probably going to be closer to 6 to 9 million. It's not going to go down. It's going to ever increase, even with you doing your portion because you get the money back.
But when we use the word retirement in this context, we're really talking about just cash flow for sunset years that you want to be able to access. I mean, some people plan with the use of government-sponsored programs, and we're going to get into that a little bit further in our podcast. But just like you said, this is a never-ending type of cycle and strategy that just builds and continues.
There's a great example, guys, of retirement in Nelson Nash's book, Becoming Your Own Banker. The whole process was financing cars. If you just finance cars, in this example, it will build a retirement, a replacement of income for you at a certain age that you can't outlive, and you'll still pass on more than you ever put in the thing or took out to heirs. It's
Right.
just unbelievable when you put all the powers of what money really needs to be doing. You organize it correctly, you're going to get the production.
So let's move into another question then. How much can you borrow from your life insurance contract and when? Sometimes you hear folks that are really mistaken about how it operates and say, well, you can't access any money the first 2 years. And that's just not true when it's properly designed and structured the way we structure it. So tell folks a little bit more about that.
Well, we have to go with the understanding that we're putting a system together. When we purchased this type of a contract, it's long-term, it's lifelong. It should never be looked at short-term. And you can't look at it like a deposit account at a bank. Okay, if I put $10,000 in a bank, then I could write checks off of it and get the whole $10,000. That's not what we're talking about here. We're talking about putting a company together or a little bank together that will exceed that $10,000 over time. Okay, so it takes a little bit of time. And how much money can you actually access? That's easy. For our clients, we have everyone call Myra, our assistant, and or call the toll-free number at that insurance company and just ask the question. They'll ask you for your policy number, and they'll immediately say, you have available X. Even when we have policy loans out, Seth, there still could be access to money. Okay, because we didn't borrow the whole thing, or we made another premium payment, or they added the dividend part, okay, the profits after we borrowed it. So that may still be available to get more money. So it's whatever's in the account according to the structure. They like to leave a little bit extra in there for next year's interest on the outstanding loans if you haven't got them paid off.
Right. So, but it's accessible from the very get-go when the policy is structured, and it continues to be available to you, like you said, from dividend payments and the policy loans that you pull out. It's still growing as if it weren't taken out.
Here's why. Let's just tell people why that's available so fast. Okay. Insurance industry, because that was the monetary system of our country, everything is annualized. If you pay an annualized premium, you get the best of everything. Annualized means they pay the earnings up front at the beginning of the year, not at the end. Most other investments, everything else, you don't get anything until it is earned because it's in the rears. So Seth and I structure these contracts so it creates the highest content, the highest dollar amount for a client that's reasonably possible for long term. I would caution people, as you look on the internet, you'll see other people out there pretending to do these same type of contracts, and they talk about percentages and splits in the different components that make up the premium. All they're after is a quick sell and they're gone. We're after helping people change their lives, learn about money, and put a banking equation in their life. So
Right.
that's important to make that little statement, but that's why the cash is available. It just takes long enough for the account to get open and registered in the insurance company's computers. And it'll register what is available right then, and you can have access to it. It's that fast.
Let's take another angle on the policy loan repayments and building like a high interest rate. Let's say that we borrowed that $100,000 out of our bank that I used in the real estate example, and we buy that investment property and it's paying us $2,000 a month. On that $100,000, if I set up a 10% interest, who benefits from that interest? And we talked a little bit about why a higher interest rate benefits us, but let's drill down on that a little bit more and explain who ultimately benefits from the interest payment and why.
Let's do this type of analogy so people can understand. And this is the way I break it down. There are two people. There's you who is in control. You know where you want to go. You know what you're doing. You know you want your money to grow. Then there's a counter you, and you meet them every morning, and they look back at you in the mirror. That person looking back at you in the mirror is in a contra world, okay? He's not you. He's doing things that you want to capitalize on. So be that as it may, he is the one that we're going to borrow money or lend money to, and he's going to pay it back because the two things that he does, he loves to spend money and he loves to go to work to support his habit. Okay, so he's a consumer. We are growers. So we have to split ourselves, and this is the best analogy for me to do that. So when we borrow money, we want to put it to work. If we put it to them and we charge an interest and we get that interest, where's that going to go? That's going to go back to us. Okay. And it's in an environment, in an economy that is triggering absolutely no taxable events because there's no new cash coming in under our control. It's the reuse of the same cash within our own environment.
It also makes the life insurance company healthier with cash flow, cash reserves that they pull together, and it increases their ability to pay higher dividends. Would you agree?
Yeah, absolutely. Owners can't steal from their own companies. You got to be honest, and you don't get any discounts.
So Nelson Nash describes this as owning a grocery store and having your wife load up groceries. Do you go out the back door and load them in your truck, or do you go through the front and pay for them? And the answer is you pay for them because the profit margin there is necessary that you need to pay for it. You have to pay for like 17 cans of peas, so to speak. You don't walk the peas out the back door. You pay at the cash register.
So that's important to realize, folks, is that you've got to be honest with yourselves. All of you hearing this right now, maybe for the first time, is that you're being raw blind as we talk, as you listen to this. That guy in the mirror is living in your house. He's eating your food. He's driving your car, bringing it back empty, using your utilities, wearing everything out free because we haven't been taught better. Okay? It's just like me knocking on your door, showing up with my suitcase. Hey, I'm now going to check into your house. I want to live here for free, eat all your food, drive your cars, bring them back empty. How long are you going to let me do that for free? I would say, I don't think I could quite get turned around before that door slams. They're not going to put up with that. This is the problem we have to fix. We teach people always how to get 100% of the money back.
I think this is probably a good place to end this podcast on how policy loans work. And I'm going to give folks a roadmap real quick about how they can find more resources on our website at privatebankingstrategies.com. That's privatebankingstrategies.com. If this is the first time you're hearing this podcast, we have a free book offer. It's What the Banks Don't Want You to Know. Secrets the Banks Don't Want You to Know. that will help you immensely in creating the private banking strategies that we teach people. And you put your name and your email in on our website, and that book becomes available to you by PDF or by audio version. We've also got the audio version of it. You can listen to it on the go. If you listen to that and this podcast is making sense, the next step is to schedule an exploratory call with Vance, which you'll find a link to his calendar in the emails that we send. So that's a pretty quick walkthrough on our process. Vance, any closing remarks on this podcast?
I just think money is something people need to educate themselves about. We all think we know something about money. And my closing comment would be a quote from R. Nelson Nash: "It's not so much what we don't know about money that's hurting us. It's all about what we think we know about money that's incorrect."
That's exactly right. Well, thanks, folks, for tuning in with us. We hope to have you back again on the next podcast.
Bye-bye.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies Podcast. Click the subscribe button below to be notified when new episodes become available.